EthAum Venture Partners. You may have seen a bunch of thought leadership panels that we posted in the last couple of months. We talked about innovations disrupting various industries in those panels. These panels were extremely insightful, interactive, and fun. We have had a bunch of different industry leaders sharing their insights on innovations that are driving the industry, trends, policies that are impacting the industries, and so on and so forth. And now we are coming up with roast sessions. These roast sessions are going to be even more exciting since startups will be publicly grilled and roasted by industry experts. And why roast session? You may not have seen that kind of format in the past, but we really believe that startups can only grow if they are getting a brutal, honest feedback from the industry experts. They are able to learn from that feedback, improve, and then they'll be able to grow because of that brutal, honest feedback. And for startups, it's extremely difficult to get that brutal, honest feedback. Most of the times, what you get is a BS sugar-coated feedback, which doesn't help at all. And that's why it is also extremely courageous or audacious from the founder's perspective to go out in public, host these kind of roast sessions, and get the feedback publicly. We are starting this series with Pentaip, which is one of the portfolio startups of EthAum from Malaysia and Singapore. And they are going to get roasted by industry experts today. Before talking about industry experts, who are they, I would request Darren and Yong to do a brief introduction of themselves. And then I would request our panelists or judges to talk about themselves. Darren, do you want to start with a brief intro, please?
Everyone, Darren here, co-founder of Pentaip and the CFO. Nice to meet everyone.
Thank you, Darren. Yong?
Hi, everyone. My name is Yong, and I'm considered a technical founder, which means that I love coding. In short, it's very simple to understand me. I love coding. Yeah, so I started Pentaip 4 years ago, and then of course the startup journey is bumpy, but finally we come to the stage that is an exciting journey start. So yeah, thank you.
But you don't have to look stressed now, Yong. It will come later. So feel free to relax. Peter, do you want to introduce yourself, please?
Yeah, sure. My name is Peter, and I run a single family office. We look into growth, equity space, so post revenue, Series A probably onwards. That's our DNA. And yeah, I'm very happy to be here. Thank you.
Fantastic. Thanks a lot, Peter. Alexandra?
Hi, everybody. I'm Alexandra. I run a business called Inclusive Asset Management, and I am focused primarily on getting institutional capital to high-performance female fund managers. My background is institutional sales, so quite far away from the VC landscape, but I've raised $3 billion in hedge funds and all sorts of different products and stuff like that. So it's definitely going to be from an institutional lens from me.
Oh my God. Wow. Fantastic. Yong, could you please start presentation of Pentaip so that we can start getting questions and feedback? So please feel free to share your screen and take us through Pentaip solution.
Sure. Okay, so is it everyone able to see the screen?
Yeah.
Okay, so the first page is actually the Pentaip. What is Pentaip? Pentaip is an AI company. So we focus on the asset allocation technology with AI, and we started in 2019. And then now it's 2023, we start to come to market. And then myself is actually a self-learned trader. And then also in the same time, I also a blockchain exchange founding team. So which means I'm a very techie guy, which means that that's the best way to understand me is that I'm a tech founder. And we actually, are trying to solve the issue with the using AI to solve some issue in the wealth management. Because what we actually started this company is we believe that investment activities will be replaced by artificial intelligence since 2019, when the AlphaGo beat the human. And then we actually believe that AI can serve more people because it's very difficult to find a good fund manager. And we believe that AI can actually perform much more better than a lot of the human fund manager. So that's why we started at 2019. But actually what we did, we actually start from this slide. In this slide, you can see there's a global data, there's a mandate parameter, there's an AI technology, order execution, and investment report. But the main message is actually 80% of our effort are spending on the global data. There, in the 4 years journey, 3 years R&D, 2 years are spending on the data preparation before we start the AI framework. And the global data preparation allow us to let the AI to take the data to train the personalized AI. So which means that the key message in this slide is these AI are very, very heavily rely on the global data. And the next slide actually show a bit more dive into the data, which means that how do we start the data processing, how we do the mandate setup, which means that the client tell what they want. And then after that, the AI take the relevant data and train, then they get their personalized AI fund manager to perform the service to them. And the best thing is the AI actually will keep learning from the market every day so that the client always get the AI that is actually up to date. So a very simple, straightforward case is how we actually serve our client. For example, our anchor client, they are a multi-generation family office. They are very familiar themselves in US market, Singapore and Malaysia market. But when come to their family policy that need to do global asset allocation, they are not familiar in the Europe, Japan, and Australia. So the whole Europe market, they let our AI fund manager to invest for them in the secondary equity market. That's actually how our client uses us. So what is the model that the client uses? Currently, we have two models. Model number one is actually usually the client request is actually that when the size that they want to assign is more than 10 million US dollar. And we call it joint venture with the artificial intelligence. And the advantage of this model is that the client set up a company with us. So which means they set up a company, we take 99%, they take 99% share, we take 1% share. And then this 1% share allows us to have a shareholder right to set up the bank account, set up the broker account. And once everything is set up properly, all the advisory, legal, technical set up properly, then the whole asset are letting the AI to run for them. And the advantage of doing this is because that the assets are still under their family fund umbrella. So which means that when the client, they hesitate to hand over the asset to a fund manager, setting up a joint venture and let the AI to manage the wealth become a quite makes sense solution for them because the assets are still under their family umbrella. So usually the common cases for these types of client is the asset have a lot of people need to do the approval process, like a family office that have a lot of brother, sister, first generation, next generation, third generation. So when they actually have a lot of approval they need to go through, assets are still under their family umbrella is very makes sense for them. But we also work with the Singapore VCC to launch a VCC AI personalized fund with Fusion Capital, which is one of our products that currently we are pushing to the market. And then there is a VCC ID here. Okay, there's a under Fusion Capital. And in this VCC sub-fund, what we actually offer is actually we offer 6 different classes of share. First class of share is actually personalized and usually are for the high level individual who don't want to set up a company. Maybe they're just couple, they not yet come until brother, sister, the asset not yet come until like a lot of people have to make decision. So for them, they can just subscribe to the fund so that it's easy for them. And then the class institution is actually the targeting the institution to customize and then become a fund of fund. So they can subscribe the AI fund according to their mandate, and they can actually repackage it into another fund that offer to their region. And the third class is R&D. This is for internal fund. And the next thing that I want to introduce is the other classes. The other classes is ESG classes and Sharia compliant classes and Sharia compliance institution classes, because we are actually targeting offer the personalized AI to the market, including the Islam market. So the ESG personalized are targeting the institution fund. Sharia compliant personalized is targeting the high net worth at the Middle East, Malaysia, and Indonesia. So I give an example. In Malaysia, there's a single family office that recently we're approaching. He will actually come back to us in 1-2 weeks time. It's actually that his family fund can come into the Sharia compliance personalized fund. And Sharia compliance institution customized are targeting the Islam bank. So which means that the bank are actually targeting to using this fund to actually to repackage into a fund of fund to come up. So I think you start to notice I always keep mentioning repackage. The key reason here is because that every client can have multiple AI fund manager. That's our unique selling point. So how does it actually looks like? The appendix is actually showing the example. So in this table, one row here is one AI fund manager. One row here is one AI fund manager, which means that not just client can choose the existing AI fund manager. They can also provide their mandate, and then we create an AI fund manager for them. And what is the return of the AI? Here we're using this table and we take an average is 31%. And then if we click into any of these, I have two samples here. One is US, one is Japan. Then this is actually the annualized return of the Japan AI. So you might notice there is a 23% annualized. And then this is a portfolio. So from here, what you actually can see is it's actually a portfolio asset allocation AI that you can see that the AI actually are allocated to different sector, different industry. And then there is also the cash holding. The AI will decide when to expose more cash, when to expose more to the stock market, so that the AI actually is an active portfolio management AI that time by time are keep adjusting the portfolio. And beside Japan, we also have another sample, is the US one. So this is a US AI report. The annualized return is 22%. So so when client actually want to confirm portfolio, how we actually finalize the mandate with client is actually, excuse me, is actually how we finalize the mandate with client is actually through confirming the watch list. So when they actually confirm their mandate, then they will ask, okay, so how do we start? Before we start, we actually will give them the watch list that generated by the AI or generated by our internal analysis or our friends or our friends from other fund manager, that we come out a watch list and we send this watch list to the client. And when the client confirm that, okay, I'm okay with this watch list, then the AI will start invest. The AI will start invest and will not invest outside of this watch list. So which means that when the watch list are contains, let's say like only focus on energy. So this AI will become an AI that only invests in the energy sector. And to highlight, I want to mention is a long only. We doesn't have a short or margin trading. It's a long only investment on the equity market. So a live case example, the family office, when we give them 200, then they will take out, okay, this one I don't like, this one I don't like, this one I don't like. So 200, it will become around 150. So because how is it, everyone have their preference. So which means that the watch list generated by AI, people might don't like, so they might take away. And then once finalized, then the AI will start investment. So beside the Japan, there is also USA. Okay, so one AI will have one watch list. So where actually we target? Where is our market? Our market actually very straightforward. We are targeting the new generation. Because before we started this company, I already predict that it will happen something that is, that time I call it the wealth transfer to next generation, which now is people start to realize. Even my first client is also happening this case. The wealth transfer from the previous generation to the new generation, and the new generation will prefer more digitalized element. Okay, so that's the reason why they actually start using us. The next generation propose us to their family, and the family look at it. Wow, okay, like it. Okay, then we started with a 1 million euro as our anchor client. So yeah, in short to say, we are targeting the next generation. So when we actually approaching, I still remember when I approached one of my team member, a fund manager, a retired fund manager, he asked me, Yong, I give you 2 minutes, convince me why I need to believe in your technology. Then I tell him like that. I say, Daniel, I'll be very straightforward. I'm not targeting your existing client at all. I'm targeting your new client, your existing client, next generation. Because a very straightforward answer, that do you think when the wealth pass to the next generation, do you think they will still stay in your fund? Then he convinced him. This sentence convinced him. Because why? Because he said, Yong, you convinced me because I cannot even convince my son to use the investment style that I believe. He want to go into blockchain. So which means that the new generation actually have their preference. They prefer more digitalized. They prefer more digital asset instead of the different way of doing it. So that is actually the market that we are targeting. During the wealth transfer, we want to bring more digital element into the wealth management, including family office and institution. So that's all. And then the final word to say, we are an AI company. And to be more specific, we are fall under a artificial specialized intelligence category that focus on the portfolio management technology. Thank you.
Fantastic. Thanks a lot, Yong. Let's see who wants to start with questions first. Peter, yeah, go ahead, please.
Yeah, sure. Well, what's the revenue model? How do you make money? So you're actually offering the investment advice services or investment management services. So I have more questions to that, but first, how do you make money?
We make money by discretionary management, which means the 220. And then we do the revenue sharing with the relevant party. For example, the VCC structure, they take up the cost to set up the compliance, and in exchange of 25% of the revenue sharing. The revenue come from 2% management fee and 20% performance fee by the AI.
I have a question. Oh, sorry.
Yeah.
So if you can buy the index for free, pretty much, why would anybody pay 2 and 20 for an equities product, a long only equities product?
Actually, it's a good question, but this one might be very difficult to be believed. The index actually, most of the index cannot beat even the SP 500. And then our key unique selling point is an active management portfolio by AI have a very high chance and double than the index, which means that through the AI doing the stock selection and portfolio allocation, the chances of getting higher return than the index are very high.
Have you actually done it?
Yeah, this table, you see, let's look at this table. Okay. Am I still sharing the screen?
No.
Stopped, yeah.
That's right. Okay, let's look at this table. Yeah. When we actually engage to client, we will use this table as the risk and return exposure. So which means that when we tell client, okay, when you engage to one AI fund manager, you can engage 2 or 3. And this is the potential risk and return table that you're exposed to. So let's start from the maximum risk. Okay. So in this maximum risk, we can see, okay, the maximum is 32%. Okay, 32%, negative 22%, negative 18%, 13%. Okay, so this is the risk that you're exposed to. And what's the potential upside that you're exposed to? You're exposed to, let's say, very low, 9%, 41%, 77%, or 15%, or even 114%. So this is actually what you can expect from the AI performance. You might expose to a very high risk, but in the same time, you're also exposed to very high return. So I will tell the client, I say, I also don't expect you to put 100% for AI to manage. I expect you to allocate the high risk asset for the AI to manage. If you're looking for something lower risk, bond is a good option. Index is a good option. But when you need the asset that actually more actively managed and then give you a chances for higher volatility, and you believe that AI can do better than human, more hardworking, then we are the right product for this kind of need.
Yeah, I have a question because you're actually providing the investment services, but I went to your website and you don't have any, you're not regulated, you have no license for that. So how can you provide, something which is in a sense investment service, and you charge the investment service fees for that instead of like providing software, which would be indirect, but still will be investment, but at least, it would be indirect. But how can you do that? And I suppose that you offer that on like discretionary managed account basis. So how can you do that without a license?
Now, for this fund, we work together with the Singapore VCC. So which means that we are the technology provider to the fund. So So, but
Okay, the fund. So you're selling a fund pretty
Yes.
much.
yeah, correct.
The fund is
Okay.
a lending mechanism for, if another way you want to place this is how you lend funds. The fund that we have in partner with Fusion, a licensed entity in Singapore, it's how clients engage our product.
Yeah. And then, you mentioned AI, but the AI is like a wide field, right? So what exactly is it based on? Is it machine learning or is it deep learning? Or if you could give us a little bit of view into what was actually used and what it's been called the AI.
Yeah, sure. Okay. This one is actually dive into a bit of details, and then we actually are ready for technology due diligence all the time because we are in the process of raising Series A. So I want to mention three things first. The first slide is actually a very high level, and then this one is a second level. But once we go into deeper, the third level, it will become a flowchart. Looks something like this. Let me see. Where is it? Yeah, this one. Once we dive into one more deeper level, it becomes something like this. Okay, so let's don't dive into this one, but let's stop at the level 2. Okay, so the AI actually have a two part. Is the part that how we actually convince the professional. First part is actually how we handle the data. Okay, so this actually able to convince my first anchor client because they everyday dealing with the data processing because they are doing value investing. So they always deal with data processing. And the part that convinced him is actually first thing, we collect the global data. Second, after the data come in, we actually slice it into different metrics, which means that by time, by time series, by labeling, and they know that the whole purpose of this is for a fast query. So when the AI need the data, the AI are very easily to get the data. So the whole purpose of the data is collect the global data and then slice it and then store in the database for the AI when it need, then it query. Then when it comes to the mandate,
I interrupt you. What sort of data? Is it like fundamental, like let's say from the income statement, balance sheet, and so on, or is it price, or is it macroeconomic inputs? What is being considered in the?
Yeah, you actually will collect the fundamental data and then the company exercise data like a dividend split and the market news and also the price data. So usually the biggest 5 category is here. Usually the dividend data, which means that the cash flow, and also the split data, which means the share outstanding, and then under also the ownership, and then the fundamental data, market news, and also price data. So which means that we collect the most basic but complete information that for financial analysis that we'll need to use for analyze data. And by the way, the data storage, we are heavily rely on the AWS S3 bucket as our main database.
What's dividend data? Is like what dividend is being paid by the company?
Yes, correct. The dividend.
And what if the company doesn't have dividend? If it's like such a input that it's highlighted in this data table, I mean, if the company doesn't pay dividends, then what?
Then the analysis process just didn't include the dividend.
Okay, but why is it so important in your analysis to have dividend?
Because you see on the stock income, actually the return from the stock actually have two main pieces. One pieces is a price gain, and second pieces is actually the cash cow, the cash flow that come out from the investment. Okay, so when these two are the main income source, the dividend actually will impact the price gain. So which means that the dividend data will impact the potential price gain. So that's why it's one of the factors that quite important. Because if this stock are constantly come out the dividend data, that means that it fall under more towards on the blue chips, fall under more to the different cap, but it doesn't fall under so much on the reinvesting into the business. So which means that dividend data is a significant impact to the price analysis.
Okay.
And then after the data, then it come to the mandate setup. So when come to the mandate setup, then according to the mandate, then the watch list will actually take the data from the database. So this part is a bit like a filtering. So which means because with the data, we already slice it and organize it properly. So when we set up the watch list, then the AI actually can take the relevant data into the mandate And then after that, it store the data, store the personalized AI into database again. So which means until this part, it start to become the personalized setting. Okay.
So who's doing the watch list?
It can be AI and it can be human, but we prefer human. I mean, the client prefer human. We prefer human to do the watch list.
Okay, so let's just go back to the portfolio construction. When you did that back test, where you were pointing out where the minimum, like the maximum loss you could probably get was the minus 32%, and the gain was over 100%. What are the inputs into that? Because that's a back test, right? So if someone is, I mean, it doesn't really hold any validity if you've got a back test which has been said by one person is, this is my watch list, and you've included some random stock. So how have you put that together, and what are you trying to beat?
You actually point out a very good point, because you're pointing out the watch lists are very important for the AI performance, which is true, because that is our selling point. Why, because I will use one of the client example. Okay, this client haven't landed yet, haven't started yet, but it's an example that he want to invest in a specific sector because he believed that after he know that I will do the active, then he wants specific that. And then when actually want to perform the watch list, then how to say, human not yet fully trust AI. So human not yet fully trust AI. So how to say, human will confuse that, is the AI really take care of the liquidity? Is the AI really take care of the stock that is a blue chips, big cap, small cap? So how we actually do is, I ask my friend, he's a macro analysis in the UK family office. I say, John, I know that you are good in the macro analysis. My client want this sector. Can you help me to pick the stock that you think are interesting? You are excited when you see this stock name. Then he pick up and then he write his editor comment, and then we present this to our client. Then our client look at it. Hey, why this stock are in this watch list? Oh, because the editor commenting, this is the reason why it's interesting. So which means that the watch list quality is very important, but watch list also the place where we serve our client to let them know that what they actually are investing in, instead of AI select everything, they don't know what the AI select. So yeah, so this answer to your first question, who build the watch list? The answer is AI can build, but we prefer human service that. And then in terms of the performance, yes, you are right that because different watch lists, different character, so that the performance are different. This is completely correct. So this is the reason that why when we look at the performance of the AI, we choose to use a matrix table. Instead of one AI performance, we choose to use a matrix of table to see the overall, to see the total overall, so that we can know that even, how to say, as long as we select 2 or 3 AI, then we can expect a 31% or 20+% annualized return when some AI perform good, some AI perform bad. So that's how we, yeah.
Can you explain? Sorry, can you explain how you could have got 112% in Japanese healthcare?
Sure.
For example.
Okay, sure.
Like it's I mean, just the numbers seem a bit strange for long only public equities markets, because obviously you don't have any leverage. So
sure. So this is our backend system. This is our backend system. So just now you mentioned healthcare, right? Japan healthcare. So let's take this one as example.
Yeah.
So let me click into it. But just for your information, the report that you see is printed by system, because we apply the mechanism that what you see is what you print. So the report that you see is captured from the yeah. So let's say I put a control P. Okay, control P is print. So you can see this is ready to print into PDF. Okay. So let's look into this. So the area rate, okay, so this one, the duration is short. That means that it's very frequent adjust the portfolio. The portfolio will be adjust very frequent. If it's a medium, then the portfolio will adjust 3 to 6 months. If it's long, the portfolio adjusts 1 year only once. So duration short means that the portfolio adjusts it every 2 weeks to 1.5 months. So that's why in the across 10 years, you can see the very small white dot, small black dot here. This is the time that when the AI do the adjustment of the portfolio. But I think this one too short. So let's find something that have a longer duration. Let's take the Japan technology as example. This one have a long duration. Okay, so that we can easier to see the difference, because this one too actively adjusts already. Okay. So when this come to the longer duration, so you will see that, okay, the AI only adjusts the portfolio almost 1.5 years, then only adjusts one time. Okay. So in this scenario, so let's say if we click into any of the stock, okay, so when we click into any of the stock, then we were able to see that how the AI actually invests and perform. So for this stock, the AI was invested into this company at 2016 December. The holding percentage is 16%. Okay, the holding percentage is 16%. And then how to say, the price when it purchased is 149 yen. Japan, right? This one? Yeah, Japan. Okay, 149 yen. And when the time that it exit is 368 yen. Okay, so it fully exited. So which means actually enter here, exit around here. Exit here. Okay. So let's say like if the client have any question about any stock, then we can click into it to see how the AI was behaved in that time, and every individual stock, how it actually contribute to the portfolio gain. So yeah, so is this answer to your question, how the portfolio was being calculated is by a lot of individual trades combined?
I probably add one more point here, Yong, is our aim is actually to beat the index. Alexander, you're right. And we beat the index at face value based on the current performance. It's easily 2 times of any index in any stock market out there. But again, historical performance does not guarantee future. That's probably the first point. We actually did, during the panel day, we have a slide that also shows the actually same period comparison on our AI versus the index, like Nikkei index, at the time of our AI training. So, and then how we do that, right? I think the question you were asking also is the stock selection or stock portfolio watch list selection. Like what Yongling said, we actually have 2 models. One is actually hybrid, right? You have a human first round and then feed into the AI to then regenerate the exact portfolio. The second, which is fully AI driven, that could be also one method. We need to say we have the AI generate. You can take the existing ones. You select your health, your sector, your risk, your tolerance, the signal that you want. If you want to break up, you want to have someone that you want a high velocity trade or high upward trade AI or portfolio, you can then go and take the existing AI and then look at it. So when we did the back testing, I think your question was how valid it is, because it all depends on the watch list. The short answer is valid because we let the AI did the whole selection, so we don't have any human intervention when we're training the AI. And then we went and did a human back test. So I personally, for example, invested into this within 3 months, 17% returns. And this is also as part of our MVP, getting into the MVP state of our product. I did this independent of our tech team, independent of Yong, independent of the developers. I said, look, and I didn't tell them when I'm going to do it. I just went and did it like as a secret shopper spot check kind of style. And that within 3 months, I reviewed the results to him and said, look, it's 17%. So annualizes roughly what you saw in the table.
But I think I also like to highlight one thing is Darren select US healthcare. And when he tell me that, I was asking, so you're betting on the post-COVID effect, is it? So he said, yeah, that is the sector that he found. So sector selection also important when come to the return.
Yeah, and this is the secret sauce to our product, because you can actually select and customize and personalize whatever based on your preference.
I mean, I think it's very impressive, and I think you've done a really good job. In terms of when an institutional allocator would look at this, though, you need to compare apples for apples, right? So if you're going to present this back test, you need to say, this is a back test we have used. We have rebuilt the world by sector indices or geography indices or something like that. And I mean, I think that you kind of have to prove that the AI works by, well, the human intervention piece is problematic, I think, because you're saying that AI works and then you're giving godlike powers to the watch list. What if your friend at the family office, who's the macro guy, gets it wrong? and he hasn't included any of the stocks that get big, and the AI would have picked them if you'd given the AI the full gamut of the market. You know what I mean? So I think the message is either the AI works or it doesn't. And if the AI is going to work, then you give the AI the full spectrum of, you can say you want healthcare, so US healthcare, fine. So whatever is in that US healthcare, you have to say to your AI, all right, well, here you go, pick the best ones, and you want to be able to outperform giving the full spectrum, I think. I don't know. I don't know. What do you think?
That's our preference. Our preference is definitely to have a hybrid model. Give the AI to run the first round of watch list, then have a human here to customize it to you or whoever the institution might be. So
And,
spot on.
So you see, everyone will have a different preference. They don't have a preference. AI come first. And even I develop AI, but my preference is human create watch list because I feel that is the place that human put their vision into the watch list.
I would say the secret sauce, final few words from me from a CFO and more strategy standpoint is this product is aimed basically invest with a vision to become smarter, enable us to be smarter. So if it's human that comes in first or AI comes in first, ultimately it's to enable us to think smarter and look at angles that otherwise wouldn't have been considered without the power of data, and make it faster as well. Because personalized, the simulation dots that you saw on one of the PDF slide that Yong-Ning presented is basically thousands of simulations with the AI ran to come up with the best portfolio based on your watch list, right? So you set the playing field for the AI. And lastly, it's consistent. Like I think it was Peter that mentioned, it's consistent. And the reason why it's able to beat the market is because it's emotionless, right? When it sells, it executes. Unlike human, sometimes Yong is a trader himself. He knows that sometimes you see that your portfolio at this particular stock, the high growth stock, making 200%, making you to sell at the 198% mark of the returns. You'll be like, I should wait a little bit more. And that's where AI eliminates that. It's the consistency is there. So at times, this also means that at times when the market's not performing well, the AI might get you to hold up to 10, 20, 30% of cash, which is not what fund managers out there would have advised you to. So that's how we achieve, smarter, consistency, and most importantly, faster as well through the power of computing.
Yeah.
How long to the past the data set that you train the AI on goes?
We trained the data start from 2000s, and then but the AI portfolio we standardized start from 2010. So which means that we collect 20 years data, because start from 2000s, the data start to be more complete. Before 2000, the data are still not really complete. So that's why we started from 2000 to train the AI.
Okay.
Yeah. And then
what does it show then from 2013, in this table where you show the performance of this backtest, they start from 2013. So that's like out of sample starts from 2013. That's why you show 2013.
Actually, with the terminology of out of sample, actually every time when the AI make decision, the AI doesn't receive any information in future. So which means that all the dot that you see here is actually AI making decision in the out of sample situation with that word. So because we cannot let the AI have chances to know what happened in the past when it make the decision, or else it will have bias. So which means the AI always need to make decision in the situation that they don't know what happened in the future. Yeah, sure. And then, allow me to share one more slide. Actually, this slide is my closing slide. When I actually approach client, how we actually close is actually that we look through one row with client. So why is it closing is because we look, the closing point is when they realize that AI do better work than human, then they usually buy in already. So you see, we start from the first row, okay? AI from 0% choose to hold
1.5%.
Yeah. Why there's a distinct? Okay. So 0% choose to hold 1.5%. And then when it comes to $2.4, then from 1.58%, it choose to exit to $0. And then when from 2.47, when the price continue go up, the AI choose to actually come back again. So a lot of human actually, when the price go up, they start to not coming back already. They start to, let's say, forget about this stock. And then after that, the price go up, the AI choose to close the position again. But when you see when the price keep coming up, 5.21, the humans start to be a bit difficult to come in, but the AI can actually still emotionless to still invest because there is a right action in that time. And then, so after that, when the price continue go up, then the AI choose to increase position from 0.8% increase to 1.6. And when the price go down a bit, then the AI choose to reduce the position from 1.63, reduce to 0.8. And then you see how the price keep coming up. Okay, when the price come to almost like $9, the AI still remain around 1.6%. But when the price fall down, come to 8.1, then the AI suddenly decided to increase the position 3 times to 4.4%. This kind of action behavior, human are difficult to do because first thing, human difficult to monitor the market for so long time. That first thing. And second thing is human have one kind of emotion is they always remember the price of when they first time met this stock. So which means that human have an imagine like, let's say like, oh, when I look at this stock is only 1.8. Now it's already $8. Maybe I just hold it. I don't do anything. Okay. Or maybe I already exit. I don't want to buy in again. Okay. This is the thing that human cannot do because I use myself as an example. I buy Yahoo at one point something US dollar when Alibaba are not yet listed. And then I sell Yahoo at $3. And when Yahoo are $7, I'm supposed to buy again, but I cannot press the button because when I look at it, it's just $1. So I have this emotion thing that I cannot do. So my client, usually they are also invest for many years. They know that the emotion is an issue. So this is actually the closing slide that they're willing to let the AI to take care of the market that they are not familiar. So yeah, just to share, this is a closing slide. Yeah, so when the AI come in around $1, and then when keep going up, then until around here, I think here, right? 2021 January. 2021 January supposed to be here. Yeah, supposed to be here. So when come to here, you see the price keep coming up. And then in this time, AI decided to add in more and then exit at this price somewhere here. Okay. So this is something that, sorry, yeah, here. Yeah, when the price are here, the AI decided to 4 times more come in. And then when go up to here, then the AI decided to exit. So this is something that human very difficult to do because human have emotion.
But I also want to flag that AI also will take into account market. So we are not fully diversifying away from market risk. So if it's a bear market, AI is also going to be subject. But during a bear market, people often will ask, yeah, when it's good times, you probably earn more than what the index. But what is bad times? That's where AI can also able to help you reduce, cut loss, or diversify your risk lesser than what you would have experienced if you expose yourself to the market. So that's where our differentiation point to other competitors. The reason we haven't spoke any single word about any competitor or competitive landscape is because we believe that currently in the market, there's no one product that's actually as close to what we have built. Reason being, most of the robo-advisor or AI-driven advisory tool are more at the asset class level. They teach you what asset ETFs, what equities with ETFs, and then bonds, commod, as primary market, and how to allocate your accordingly. But our AI, or what the product that our company believe in, goes beneath the underlying assets. We look at what Yong said earlier, all the transactional data, fundamentals, technical data. And that's where, if you can consolidate and triangulate and get the AI to learn the most complicated form of data, which is the secondary underlying asset data, and that will differentiate us from a competitor. So that's the complexity to doing this exercise, and the data itself makes us stand out and the competitive edge across our competitors or other.
Thanks a lot, Darren and Yong. I think we are already over time, but let's see if there are final comments or recommendations from Alexandra and Peter.
I don't really have questions. I will have some, I think it's a very short time frame, for at which it was trained, because it's only like 20 years, and it's very infrequent how it, so I think that there is going to be bias to overfit, because now we had, over the last, from 2010 till 2020, or actually 21, there was quite good period, and just buy something, sell something, but we didn't, there is going to be regime shift, there will be different regimes of the market, and it's going to be challenged, because if it train on certain, let's say low inflationary, low interest rates environment, it's not going to really work, if these things change. So I would be, I've seen the last 20 years, I've seen many sorts of, it used to be CTAs before the AI that would be, trend followers that will be using some algorithmic trading, more frequent, less frequent, but they tend to simply not do well when the market changes, when it's different than it was before, and we had really big names, that it stopped working, lost AUM as a result, so also, when you say that the risk is going to be 31%, then if you don't have 2008, which was a completely different market environment, then you cannot say it's going to 31%. It can be easily much worse. The index was down 60%. That the Russian index was down 70%. Things like that. So you just don't know what risk you really run unless you have that. But maybe you have it in data. I don't know how it would have performed during this environment. But this would be my concern, and also I don't know how we really want to scale up the business, as you have because you have different, and say people can choose, people can do that and this and that, and then have you have this one fund, but people can say a sector, they can say they can actually adjust the watch list as they want, but you cannot really do it in a fund, so I thought that you would be selling that as to investors, that can open the interactive broker's account and then to run it. But then you would run into troubles because you're not regulated and it's not as easy. So, but it's different thing, because I'm looking on that, from perspective that I would be investing in you, not investing into the system, which I can pick out of 2,000 hedge funds, to invest with. So for me, this would not be the preferred way. I would be looking that I invest in a WealthTech solution, not being a WealthTech client. So I'm talking from that perspective. But but I think it's we don't see the full picture from what we see now, and I think the risk might be much higher, than we think. And I don't know how it's going to outperform over the long term. Usually, it tends to mean revert. There is a good time, when things outperform, and then simply they don't. So in the end, you just come back. But yeah, that's my
Thank you, Peter. Appreciate it. Alexandra?
Yeah, so I think it's very impressive. I think you've done a good job. I think that you're confusing the narrative a bit, saying that we are AI people and AI is better than humans, yet you're putting a human layer on top of that. So I don't think that the story is consistent. So if you want the AI to be the story, then the AI is the story. Secondly, what you're trying to do is replace human active managers in a long-only equity space, and that 2 and 20 pricing for institutional investors is just not viable at all. You would be looking at and this, I've just done this work, it's about 50 basis points for an actively managed portfolio, probably 75 for an Asian equities manager. So if you're going to go to institutional investors and say, hey, we can do this, we can get you better returns, you're going to have to compete with those fund managers at those prices, I think.
Maybe there could be something like, from the outperformance, you get 10%, or, that's
yeah, for sure.
Would be acceptable, but it's definitely not 220. That's not even hedge funds, are like charging that. I mean that it's simply it's going to the whole world going to the lower fees levels because they just don't really deliver anything for those 220. Yeah, so that's that's definitely a valid point, Alexander mentioned.
Yeah, thank you. From my side, actually, how to say, because I understand where Peter come from, where Alex come from. Yes, we are actually replacing the active fund manager, and then most of our clients choose us is because they are our client hate human fund manager. Very simple. sorry, but it's bad. Our client, they hate human fund manager because my clients, like I say, Young, there's a joke in our industry. Our industry is all the fund manager are richer than their client. They are not really working for the client. So that's why we want to use your solution. Okay, so there's a product part. We are in a very, very niche market. We are on the wealth transform. The people want more digitalized. People want more AI. People want there's alternative than human only. So we are going there. And we're charging 220 is showing that we have confidence because we don't want to, let's say, like if we come, technology cost is very low. If we come with a 0.5 basis point, I think we will become everyone enemy. That is also what we're trying to avoid in the beginning. So we just go by 220. And when back to the Peter.
Actually, so sorry for interrupting you, but the returns were net of fees.
Mm-hmm.
The returns you showed in the back test, that was the net of fees. The fees were incorporated.
Yeah,
or was it
net of fees. Net of fees. Yeah.
Okay.
Net of fees.
Yeah.
Have you got any of actual data that you've invested of your own money?
Yeah, Darren have his own data. Yeah.
Yeah, because that's more important because every time you show a back test, every institution will say, well, I've never seen a bad back test.
Yeah.
But because you can engineer whatever you want, and really you guys can, because I can see that in the programming and the tech. So it would be, even if it's a small amount of money, you should be investing money so you have a real track record, so you can demonstrate that for sure.
Correct. Yes. So we actually are running the fund, Darren fund, and also the VCC fund setting up. So that one will target to launch at November, and our anchor client fund are also target to start at November. And the bank fund, they set a timeline at the next year April. So which means that how to say, there will be we will not start small. We will start from a certain size, and hopefully will be something changing the industry.
Good. Excellent.
Thank you.
Thank you. It has been really fantastic. Thanks a lot, Alexandra and Peter, for your questions, for your insights, for your recommendations. I think they are extremely helpful. And I'm sure Darren and Yong have better understanding on what are the challenges that they may be facing in the future and how to solve them. So really appreciate your time, and hopefully we could reconnect again in the next couple of weeks, months, and see how we can collaborate and support each other. Thank you. Thanks a lot, everybody.
Thanks a lot.
Good luck, guys.